Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, December 19th, 2024. It's 12:04 p.m. Eastern Time. I'm starting the video, so we're about mid-session. And I won't be a long one, just going to reiterate what I've pointed out recently, what I think warrants continued monitoring, some of the most important things in the market right now, and then time permitting, if I can just keep the market stuff pretty short, I'll hit on a couple other non-stock market trade ideas I've been highlighting recently, including natural gas. All right, so let's see if today will be the break the streak. For those of you, I believe I posted it. Yeah, I did the other day in one of the posts through yesterday. This is the biggest streak going back over 50 years, or about 50 years, 1974. If you recall, if you're old enough to remember, or if you study history, that was towards the tail end of one of the worst bear markets in history, the early 70s, even the late 60s. We had rising rates, inflationary period, similar to not so different from now. So we'll see what happens today. This is DIA. The Dow is really an insignificant index, in my opinion, and that of some others, but it's still widely quoted, talked about. You know, turn on the NBC Nightly News, and that's what they're going to talk about, not the NASDAQ 100 or even the S&P 500. So either way, we'll see if it's insignificant. But what odds favor. We get an update. Now in statistics, just because we go down, 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 if it's coin toss, that doesn't change. You can flip heads on a coin 10 times in a row, and you might think you have a better odds at flipping tails the next time, but your odds are still 50-50. The stock market's a little bit different because of the nature of a security being oversold. You have extreme oversold conditions right now in the Dow. Well, not extreme, but we've hit the 30 level. You can see yesterday we kissed the RSI right there. And, history shows when you get oversold, especially in a bull trend, that usually you get at the very least a little buyer step in. And it's not just that, you're also at support. So again, odds favor a green day today. We're green by a little bit today, but let me show you the charts. And more importantly, not today. I don't think many here do binary options. Those are involved in this casino of a stock market that they've allowed in recent years. A lot of traders are now betting on the binary options, where you can bet whether the stock market's going to close up or down in that day, on any given day. You've got, of course, crypto and all these other casino type things now, even futures on. You can bet on the election results, as I highlighted back then. So it's the stock market. The regulators have allowed it to be an outright casino, and that's what it is. So bottom line, the takeaway from that: play it while you can. Or play it as you can, and just know that when the tide turns, and this is what I'm going to just kind of lay out here in the trading plan. When we get the next sell signals that I've been highlighting, we're still on that trend line on QQQ. When we get the sell signals, and the way it works is there's not just a single event. It's not all binary, all or one, boom, heavy short below this level. It's incremental, as you go on and break additional support levels, as additional market leading stocks, particularly the top 10 in the NASDAQ 100, break down one by one. It just gives you an additional check mark and increases the odds we're going to go on to hit some of my longer term targets. So I'll get to those in a second. The takeaway is, let me go back to what I was just saying. Let's say if I'm correct, or more so when we get these sell signals, the next sell signals that help solidify, again, a break of yesterday's lows, like I talked about in yesterday's video, will certainly help. I believe the best bang for your buck are going to be the most popular risk on assets, and that's going to be the NASDAQ 100. Is an easy, QQQ or any of the derivatives, the inverse, SQQQ or QID if you want the leverage there. PSQ is a non-leveraged short for the NASDAQ 100, meaning it just goes down. It goes up in value. You don't have to short it anything. You can buy PSQ and it's inverse one time, no leverage on the NASDAQ 100, for example. So I do believe that will be one of the better sectors to short on the way down. When you start to see risk off, money will flow out of those names, NVIDIA, Apple, Microsoft, Amazon, Tesla, and the likes. The other thing, of course, would be Bitcoin. I've laid that out as a short trade recently, and I think that will vastly outperform to the downside. We're already seeing, a lot of money coming out. Gold continues to suck wind. There was a lot of money going into that. So basically, what you get, again, not more of if, but when the tide clearly turns. We have only some early sell signals recently on the shorter term charts. We're still waiting for that trend line I'm going to get to in a second on QQQ to go. But when that goes, you're going to see a reversal of that risk on trade. And what it is to a very large extent, it's an unwinding of a big margin bubble. Anytime you get the stock market really frothy, animal spirits are running hot, everybody's bullish, all the analysts are bullish, shorts have given up, which is a lot like what we had recently. And then you get especially those very odd, not odd, but unusual poor market internals like we've had recently. Again, we've had some kind of very stark things I highlighted, and the media's kind of jumped on it recently, how we've seen the outperformance. We've seen the Dow and even the S&P 500 do this recently, and the NASDAQ up until yesterday pretty much doing that. And that, again, it shows that it's all, well, you can't see it here, these guys right here to the right. The same top components that are in the NASDAQ 100 are also in the Dow. There they are. The big names right there. And you also have NVIDIA. It's not showing on here. This is on a QNDIA. They're not updating the holdings yet. NVIDIA is a holding now of the Dow, but its weighting is actually, believe it or not, pretty low. They have I checked it today. I went to I'll show it to you. This is it right here. I had to download the daily holdings here. You can see on DIA. Again, it only matters if you're trading it, but it does, the headlines do affect consumer sentiment. Overall, again, you and I are doing this day in, day out. That's why you're here. That's why you're using this service. You're either maybe you're an active trader, maybe you're a typical swing trader, maybe you're just an investor trying to get a kind of a feel where the bigger trends are, opportunities in your long-term accounts. But Joe Schmo turns, they don't deal with this intraday. They might check their phone every now and then, but they get their updates on the nightly news, and they'll hear the big headlines like yesterday, Dow down big, the market down big, and despite another rate cut from the Fed. But you can see here the weighting of NVIDIA is only 1.866%. Goldman Sachs, this is what's running the Dow recently. Goldman's about an 8% weighting. United Healthcare about 7.25%. Microsoft pretty heavy at about 6.3, and so forth and so on. So again, if you're going to trade the Dow, you need to know that. Why do you need to know that? Because then you certainly want to chart those top components, because they're going to have a much bigger impact. Just show you where they're at real quick. So Goldman, this is a busy board, but I'll just draw the line over. This is the most significant trend line, comes off the October 2023 lows. And right there, we're right on it right now. I just overlaid the trend line. So lots of clean reactions. I'm showing you all the reactions here. And so maybe one last hurrah. It would be unusual. Not extremely rare, but unusual. Oh, no, wait. We already had the little reaction there. There it is. Today's reaction. So we did get that one last bounce. Again, you don't go from here to here. One of the biggest drops in months on Goldman, a 10% drop, and then go right down through it. It can happen, but it usually doesn't. Usually you're going to get at least one last hurrah, and that's what I think this is. So the message I'm trying to convey is, I believe that if especially those that wanted to be short but wanted to wait for a better evidence, again, I cautioned you yesterday, you don't short on the trend line. We were on the trend line at yesterday's close. Let me go to QQQ. We'll talk about that a little bit more. There's the daily chart right here. Here's my clean board right there, the yellow trend line. We hit it at the close yesterday. As I said, that hit. We had SPY at support, IWM, all the major indexes at support, including the Dow. I just showed you on that board. We had price support right here. The big gap, it was a gap backfill. This is a massive gap, so big that a blind man can see it. Traders love those gaps. When a gap is once a gap is entered, it's often backfilled, and then traders will buy the bottom of the gap. Likewise, if a stock enters a gap from below, traders will sell the top of the gap, usually on the first time. And there's an example where the gap was established here, and they bought it to pull back to the top of the gap. So it's the top and the bottoms are the gaps that act as support. So I already covered, IWM yesterday. I covered all the other indexes. IWM, put on all my lines here, go to this board. Beautiful, hit of the trend line, parked right on it yesterday. So again, not to beat a dead horse, but it's basically a solid break, especially a solid daily close below yesterday's lows should do the trick. And this is just that one little last hurrah. And hard to say how far, but I can tell you if it got up there, for example, if you want to short IWM, 226.72. Remember, before yesterday, I gave you this chart. I gave you two yellow lines I said were the most significant support levels that if and when taken out would trigger the next sell signal. And that did. We took it out in one fell swoop, both of them yesterday. And so the way technical analysis works is support, once broken, becomes resistance. So it's simple stuff. There is no guarantee that if we bounce back there that we have to get rejected and go down. But what I can guarantee you is that a well-defined support level was taken out yesterday, and it should act as resistance. If it doesn't, the next resistance level will be back test of the trend line from below. And then if we go higher than that, or let's say we back test it for some period of time, then I do this. I'll draw a trend line off the highs. So let's say we zigzag up. And then you have a downtrend line and an intersecting uptrend line. So maybe we get up here. Anything much more than that would be hard to spin as anything but bullish, because if we take back the trend line, then that means this whole thing yesterday was a false breakdown, and that's pretty bullish. So as of now, I don't think that's going to happen. In fact, like I said, you can try to hold out for that if you want to be an IWM short. Me personally, I wouldn't. I told you yesterday, I think the bounce will be kind of muted. I think yesterday was kind of a knife through the heart of the bulls. And again, it's more about the technicals. There was a gap right there in IWM. And so today at the highs, we backfilled, or we tested that bottom of that gap right there. So again, those are your resistance levels right there, where we hit today's high so far, there, and then there, right, with that downtrend line. And let's look at SPY. SPY, remember, we already took out the trend line, but it wasn't very well defined. So as I told you, I'm putting a higher weighting on the QQQ uptrend line off the August 5th lows because I have more reactions. It's more obvious, if you will. But there's much better price support right there, which again, as I covered in yesterday's video, we parked at the close. So this is that reflexive bounce. Again, it's not that you can't smash right through support levels, but usually coming off new highs. It's Pavlov's dogs. The bell rang yesterday. Pavlov's dogs are conditioned to buy dips, and so a lot of them don't see the charts the way I see them. Maybe they don't even use charts. Maybe they're just mechanically ingrained to buy every dip because it's worked so long. And that's what happens is when that stops to work, a lot of folks you'll see there's probably a lot of stops set up below yesterday's lows. And there's also a lot of people that have been knowing that they've been holding out. The market's been rewarding them for doing so, and they've been sitting tight. And yesterday's kind of little gut punch. It's nothing big depending on where you bought. Now, if you chase this rally here, and that's what I want to talk about too. Let's talk about what yesterday did. So let's just we'll go back to the S&P, and then I'll get to QQQ. So in one fell swoop, we were down. That's a doji right there. It's a slight negative close, but for the most part, most of the drop was yesterday, and you can see it wiped out. If all you have to do is take a line or put crosshairs up on your chart, you go back, and so we're back to where we were now in the beginning of October. So in one fell swoop, we wiped out all the gains from so far in December, all the gains from November right there, and took us back to October's highs right there. And so, in other words, all these, everybody that bought here now that had profits, they're back at best. Most of them are underwater because you can see the majority bought up here. Now, again, that's not a death blow to the market. And more importantly, we had pretty good support. We're quite oversold. Not oversold on the daily chart of SPY. Dow kind of had its own unique thing going on because it's so concentrated. Remember, Dow only has 30 stocks, so it's not representative of really anything. It's certainly not representative of the entire U.S. economy. S&P 500 does a better job, but even then has a very high weighting towards tech and all that other stuff. So that's it. Let's go back to QQQ because I'm probably spending more time on those that don't matter as much to me. But again, yesterday's lows should do the trick and SPY. There's that trend line on QQQ. I've been highlighting forever and a day since August 5th lows. This is that little reflexive bounce. All I can tell you, it's hard to say how much upside it has. I can't guarantee it's going to break. I think it breaks. All I can tell you is if and when we have a solid break of that level, especially a solid daily close, that should be a pretty significant sell signal. And if not, if we whip back up afterwards, whether it's a day or two below, then what you don't want to see if you're short is a solid recovery back above the trend line, especially this Fed candle yesterday. That was a big candle. It's not a bearish engulfing because bearish engulfing has to engulf the body of the previous candle, and it didn't do that. It is just a big red candle. Now what we do have the potential here, when we go to a weekly chart, let's turn off all the lines, we have a potential bearish engulfing forming on the weekly. So unless this market can giddy up and go into tomorrow's close, it has to get to have a bearish engulfing. You have to engulf the body, not the entire candle, the body of the previous candles. That's this line right here. So if we close the week below that line right there, right now there is a bearish engulfing, but this is a weekly chart. Today doesn't count. Tomorrow at 2 p.m. doesn't count. Tomorrow at 4 p.m. counts because that's when the candle's finalized. And those bullish and bearish engulfings are powerful. I pointed out this one back here. We got short right there before that was the biggest drop in years, one of the most profitable bear markets to trade in years. And that was marked by a bearish engulfing at the top, which was highlighted at the time. And just like when the market bottomed, both the S&P 500 and the NASDAQ 100, it was actually the S&P 500 put in the bullish engulfing. I think we got one. Here it is. Oh, I'm sorry. It was on the daily chart. We had the bullish engulfings were on the daily charts of at the lows. Turn off all the lines back in 2022 right here, October of 2022, right there. So there it is. There it is. Somewhere in here. All my lines got moved, but it was highlighted there at the time. It's hard to see, guys. I'm trying to squish this chart down. You have to hear. I can show you. That's it. That's what a bullish looks like, and that's what was printed on the NASDAQ 100 as well as the S&P 500. Pretty much all the indexes. So they're not the be-all, end-all. Sometimes you get them and they don't mark tops or bottoms, but quite often they do. Just like that MicroStrategy trade update I gave you today, that followed with a bearish engulfing candle at the highs, MSTR, and there was additional evidence, including but not limited to the divergent high. We also pointed out what was a likely buying climax. It marks the end of a run, a bull run, and now we've taken out that level we were testing earlier. That opens the door to T2, T3, and T4. All right, so that's it. And by the way, guys, the weekly chart is more powerful. What I mean by that, you get, I try to hone in, get my entries and exits. I try to be pretty precise. I'll zero down to usually the 60-minute charts for swing trading and take buy and sell signals on that time frame. Sometimes I'll drop down to the 15-minute charts. Depending on how actively I'm trading, I might even go to the 5 or 1 minute charts. But the weekly chart is more significant for the longer term swing and trend trader. Even those of you who are trying to manage your 401k and maybe, change up your asset allocation, maybe reduce your equity holdings or increase, cash or whatever. That's it right there. There was a bearish engulfing on the weekly right there. That marked the highs. We have a bearish engulfing forming here. And if it was just a random bearish engulfing, it might not mean too much. You want to look for those only after an extended uptrend because bullish and bearish engulfing candles are topping and bottoming candles, potential. And again, you need to see them confirm. First of all, you need to see it finalized. And then I like to see it confirmed the next week, start moving away from there. And it's a simple strategy. It either works or it doesn't. So if you take it, you do this mechanically. Again, if it aligns with your outlook, you take the short, you put a stop above this week's high. Let's say you get tomorrow, heading into the close. If that candle looks like it's certain to be finalized, you could even wait, 3 o'clock, 3:30. If we're down, anywhere around where we are now, we're not going to rally back up that much and at the last minute, last hour of closing. So you could add on or initiate a short position and put a stop right above the high. And then increase that short position if next week or you get a solid close. Again, that's the next sell signal, and it's the powerful one that I've been waiting for, and we still don't have. Again, this is the trend line off the August 5th lows. Closed at it, hit it yesterday, and we've been just kind of hugging it. And again, I don't get cute and try to game counter trend bounces when a trend is this long in the tooth. These divergences have been building, sentiment has been building, and again, at most, I think I pointed out yesterday, maybe if we get a bounce today, tomorrow, up to about 526.24, and you want to try to game a bounce off this level, that would be a level, potential bounce target. But I think at this time, especially for the less active trader, if you've got some shorts, maybe just sit tight, waiting to add once these levels go right there. The trend line really in QQQ and everything else I covered. IWM, SPY. Let's dig under the hood a little bit. Look at QQQ today. They're buying the usual suspects. That's what Pavlov's dogs do when the bell rings, meaning the dip buyers. Here, I'll show you over to the right. I have my NASDAQ 100, all the holdings. I sort them by market cap here. You can see that it's just the usual suspects. Those that the public views as invincible because they have their big stock buyback programs, their earnings juggernauts. But again, they will collapse under their own weight at some point. Tesla's starting to, down today. Broadcom's down. But one day doesn't make a trend. And then what I like to do is show you this, my real-time breadth indicator. I sort by percentage gains. I scroll down to the last one positive, which is right here. Palo Alto Networks. These two are flat below it. So, and then at the bottom, and you probably can't make it out, it says 49 of 101 items. 101 because Alphabet has 2 share classes. So that's why there's 101 components of the NASDAQ 100. And you can see that only less than half of them are trading positive today, giving a false guise of strength. The NASDAQ 100 was just up. Palo Alto Networks, I think didn't I have a trade idea on this one recently I shared? Maybe it was on the 60-minute chart. Maybe not. I thought it was. I don't see where my lines. Oh, it had a split. That's what happened. And there's all my lines right there. So, okay. Anyways, okay. A little squirrel moment there, getting off task. But what I wanted to show you is, again, the impact of the big. So the Qs just went flat now as I'm doing the video. I think they were green when I started. But then you look at QQQE, which I do, and that just also shows you what's really going on under the hood in the NASDAQ, and shows that this. The market breadth is still, the internals are still very poor. It's just a handful of companies giving a false guise of strength to the market when the majority of stocks are going down. Again, I have that evidence in many things. My breadth indicators for a long time, percentage of stocks trading below or above their 200-day and 50-day moving averages, things like that. There's 101. But I don't need to. I think the media has highlighted recently. You can read the articles to see what I've been saying about the poor internals. And again, I illustrated that by looking at the divergence between the S&P 500 and Dow versus the NASDAQ until recently, or even just the equal weighted. This is QQQE, clear bearish rising wedge. And the QQQE is down 0.5%, while the NASDAQ's about flat right now. Solid breakdown there above the trend line off the August 5th lows. And so as I'm doing the video, we are starting to crack that trend line now. There it is. There's the clean board right there. Not by much, coming up on the lows. And let's see if we can get a solid close today. Even a dump into the close. That should be another knife through the heart of the bulls. And more importantly, it'll have technical significance. I often say this. Anytime there's a big move in the market, I think a lot of people read too much into it, a big up day, a big down day. And some big up day or down days are very important, or what I call technically significant. Yesterday, it was technically significant when we got the breakdown to the initial level, but then we parked on support. A bounce today wouldn't have done anything different. Now, the next if we can break down below here, whether it's today, tomorrow, or next week, or 3 months from now, we break that trend line, that's technically significant. Whether it's a 1% drop or a 3% drop. So that's what I'm looking for, as I've been stating since yesterday, or a long time actually, waiting for a next and a pretty powerful sell signal to come there. If you are new to the site, I've laid out targets months back that I still maintain, and they're right here. T1, T2 was hit there on the August 5th lows. We covered all shorts, went hard long, reversed. T3, 4, 5, 6, 7 remain my final targets, calling for a drop of about 50%, chop in half. If that final target's hit, they also align with key Fibonacci retracement levels. T7's down there would be a full retracement of the move off the lows back here from October of 2022. So first things first, and that first thing is a break of the trend line. Second thing would be a break of the 200-day moving averages, which would also be a 23.6% retracement just to get there. These are your fibs right here. 23.6 is your first key Fibonacci retracement level. Again, that's a retracement, a 23.6% retracement of the move off the 2022 lows. And then that would also coincide with another test of the 200 days, which Pavlov's dogs will probably come in and buy, at least the initial pullback to it. But it's just been checked already. That's where we covered and went long here. And this rally has, to say it's gotten long in the tooth would be a gross understatement. So personally, I'll let you know at the time whether I plan to cover special. And I'll try to speak to active trading and then swing or trend trading positions. But I can tell you as of today, if I had to, lock everything up for, a period of time and I couldn't trade, I would tell you I would sit tight and ride out any bounce off the 200 days, because I think we'll probably go on down through them next time with very little, if any, reaction. And then when we do, this is a level T1 right here, my first target from there that was hit about 450. I think once that level gets taken out, we'll just blow past that low. Everyone will be looking at that low from August 5th, and I think it'll be a pretty quick ride. This is, again, so what I try to do my best, and this is far from exact science, not only tell you where I think things are going, but how they're going to get there. And the relevance there is I do think we'll start to waterfall down. And once we take out the 200s, we'll be in that kind of impulsive selling mode. And probably shoot it right on down in pretty quick order to T3 if it plays out that way. And the takeaway there is because I've become less likely or less willing to want to game bounces off support, early on. And if you remember back then when we were trading that leg down in 2022, 2023, to go to this board, we had plenty of opportunities here. I highlighted divergent low. We gamed covered shorts. It was still on the site, and go back there. Covered shorts milked out most of that 17% counter trend rally. Went right back into the 200 days. There was that, plus a trend line break to get short again, sell those longs. We did it again here, so we gamed, from an active swing trading position, we gamed those two counter trend rallies. We rode those big legs down short, and then just look for these divergent lows. And so the takeaway is, if we get that, like any bull or bear market, that's why, I'd put a lot of short trades on in a rising market. And do the same thing in reverse. Look for divergent highs in an uptrend, game the pullbacks. And then finally, all trends come to an end at some point. And so there's your primary uptrend line off the early 2023 lows in the NASDAQ 100. The SPY comes off the lows in October there. These are the big levels. So if you really want the highest probability sell signal that or you really want to increase the odds, those long-term targets I have, which I know might be considered aggressive by some, you wait for these primary trend lines to go. That's QQQ right there. SPY, let's see which boards I have for you. I think I have it on the weekly chart. All right, somewhere in here, I did that thing where I paused the video to collect my thoughts and go to the next chart. I don't know where I left off. I was just covering XLU, talking about the stocks that don't matter so much in the S&P, but they're great if you want to trade an individual sector. You can use a sector ETF like XLU. We shorted that one back here. I had S1 hit that first support level a couple times, bounced from there, and the same divergence that was the reason for this trade, giving you 3 targets. We went on, made it ever so slightly in marginal new but still divergent high, and typically the bigger that the divergence gets, the more powerful the ensuing trend reversal. And so far it's been just a straight down, but right to the dual support. You have the primary uptrend line, very well defined uptrend line, and T1, which was price support. We hit it yesterday, and so that's why they're buying the utilities today. So and what I was saying in the video, I think let's pause there. If you're looking to game a bounce off there and then get back in short, that would be an ideal target around 78. But then you'd also want to wait for a break of the primary trend line before going to a very heavier full position, in my opinion, because you'd still be above trend right here. Okay, again, unfortunately, I don't know. I have no way of knowing where that pause button didn't unclick, but that's it. I don't want to beat a dead horse. Just want to tell you we're still at those key support levels, whether we close green today or not, we're really unless we take out, like I said, if we take out the recent highs, then this whole thing was just nothing more than a pullback and a buying opportunity. However, if we can break a solid break and close below this uptrend line, especially on a weekly chart, you want to minimize getting whipsawed. Look, if I'm right or even partially right, let's just say, in other words, we don't go all the way to my 7th target, a full retracement of that move off the 2022 lows. Let's just say, for kicks and giggles, we go down here to T, or my next target. All right, let's just do that. My next target, T3, from where we're at now, is down about 20% from current levels. And so if you were to, if you shorted yesterday on the minor trend line break, or you want to short after we get a solid close below here, the recent highs, to put a stop above that candle, is only you'd be less than 5%. It's about 4.5% to the top of that candle. That's a very good, let's just say you use then a 5% stop. Let's say you wait till we go down a little more and break the trend lines. Now you have a good 4-to-1 RR. That's a very attractive risk-reward ratio. But more importantly, if tomorrow at 4 p.m., that we finalize this bearish engulfing, especially below the uptrend line, that is what I call a high probability sell signal, and a sell signal given on a weekly time frame. So that's not looking for a pullback in the next week or two and then cover and then go longer. That's looking at a longer term sell signal that could last easily, measured in months, potentially even in years. But first things first, support is support until unless broken. So I'm going to wrap the video here. That's where we're at. All day we've been kind of bouncing on that level, and that's it. So it's a very good support level. I expected a battle, at least something here. I'll welcome whatever comes, the breakdown, if it comes today, tomorrow, or next week. Any bounce back, like I said, ideally, if you're looking for a level to short back into, or even game a bounce off this level, I think they're about 526.24. It's going to be about a 2% bounce. But again, one that I don't think the RR is worth gaming. It's not worth, in my opinion, trying to milk out that 2%. I'd rather just sit tight on the short positions now and then add once I see the next sell signals I'm looking for here. On break a QQQ there. And again, to recap what I said earlier, my favorite things that I think will outperform if we get those next sell signals. The NASDAQ 100 should outperform on the downside. The small caps probably take it pretty hard too if they break down as well. More so because, sorry guys, I wanted to talk about bonds. I almost forgot about that. All right, so real quickly, remember, to me, it's all about bonds. That's why I think we'd have a much better rally today if yields were going down and bond prices were going up. But yet it's another down day of yields. We've taken out the previous highs. This is IEF. Remember, I've color coded it to make it very simple with these zones going back all the way back in the beginning of the year. Now we are solidly in my orange zone. I know it's a pretty busy board here, but this is my orange zone. Again, that goes back to earlier in the year. And we are now, this is where we're at right here, right smack in the middle of my orange zone. And so that's why I believe that we didn't see more of a bounce off the market today. Had I seen earlier, or at this point today, yields coming back up pretty sharply, then I think that would have supported a bigger bounce in the market. And it still could. I want to show you what I see here on IEF. So this is a 60-minute chart. Showed you divergence here. Remember, we got bullish from bonds right before I went on vacation. Right when I got back, I said, right here, time to get out. We milked that. RR is no longer favorable. That was based on the divergent low and the trend line break there. But we also have potential divergence here on the 60-minute chart IEF. Right now, I'm just extending the divergence lines if it can reverse soon. Now, keep in mind, if that reversal is due to a flight to safety bid, in other words, if QQQ breaks down, solid breakdown, sells some, you see everything going down, Apple starts falling, Tesla, the leaders start to break, and Treasury bond yields are falling and bond prices are rallying, that's a flight to safety bid. That's not necessarily bullish for the stock market. They're buying bonds for the wrong reason. So keep that in mind. But as of now, we're in the orange zone, and say what you want about it, but nobody can argue that the rising rates are not net bearish for the stock market and the economy. That's not really a debatable thing if you have a background in finance. The $1 million question is, where's the kind of the everyone might have their different thoughts on where the red zone is, or orange zone, or at least what I call those things, where it starts to matter. And again, to me, it's been more of a function of where you're at here relative on the levels, as well as how long. It's been a long time now. Remember, Fed started cutting. This is the third rate cut in a cycle, and rates have done nothing but gone up, bonds falling since then. And so there was a lot of expectations. Imagine owning a business, or imagine a big a publicly traded corporation that has a lot of debt coming due. And we know that. That's also a fact. There is a huge thing they call it the debt wall. A lot of corporations that refinanced or took out loans, they're ongoing financing. Small caps are very dependent on financing, and they took it out post-COVID when rates were at the floor. They had very favorable rates. They expected to come due and roll over at low rates again, and rates have gone nothing but up since then. And now, the market's expectation is that rates would be a lot lower. Here, let me flip over to TNX. TNX is a 10-year Treasury yield. You can see here, I'm going to go out to a daily chart. So what I'm showing you here is that we do have potential positive divergence right here. And that means yields have been going up. This is post-Fed. We have taken out that previous high, which I said would be significant yesterday. So this is one reason, unless we see a big reversal, to stay short right now. The market is not going to like this. I tried to rally today. It was a rally that I might normally have wanted to game because we were at support, the key trend line. But again, when I saw yields all day have been rising, bond prices falling, that does not support a stock market rally. It's only going to go so far before the stock market gets the memo. And then down here, you can see, I've covered this many times, the PPO zero line, which is that dash line in the middle, on a lot of securities does just a phenomenal job of defining or delineating bullish and bearish trends. It's really simple stuff. When you are above the zero line, the trend is bullish. You can see these shaded boxes. This is the PPO crossing above here, here, and here. And you can see that define the biggest trends in uptrends in Treasury bond yields, right? And that's no bueno for the stock market. And then when you cross below, what you did, you were below here and here, you had downtrends, right? It's simple stuff. Biggest downtrend right there. The two biggest downtrends were defined by the PPO being below the zero line. What happened recently? It looked like we could have crossed, looked like we were going to cross the PPO lines, but they bounced. And they often do that. Once you're above or below, the zero line tends to act as support or resistance to keep a trend intact. So in pullbacks, you want to buy pullbacks to that trend. Now, so if it crosses over here, and it does it soon. You're going to confirm the negative divergence. Yields may go down, and I might put on treasuries as a trade long treasury bonds. Now, that may coincide with being either long or short equities. It depends if it's a flight to safety bid. But what I've been doing this year, you've probably seen a lot of these, and batting close to 1,000 on this, going long or short treasuries at the right time, and quite often using those as an indirect hedge, whether I'm long or short the equity markets, the NASDAQ 100 or whatever I'm trading. And it's worked out very well because I take the trades based on their own technicals. So in other words, so I'm only going to go long treasuries or the 10 or 30-year treasury bond because I can make a bullish case to go long. All right. But then quite often I'll do that, and it'll often work as an indirect hedge to a index short. All right, so that's TNX. TYX is the 30-year Treasury bond yield. You can see that here. That one is clearly broken out. You do also have that potential negative divergence. Why did I say potential? Again, another term. I've made up a lot of terms over the years. I consider divergence only potential when this is negative divergence, because you do have lower lows in the indicators, which is technically, everyone else will call that negative divergence. It is, but I like to call it potential divergence because these are momentum indicators, and right now the lines are still pointing up. And so I like to see a bearish crossover. That's when the PPO line crosses a signal line like it did here. I like to see it cross at lower levels. At that point, it is then what I call confirmed divergence. And so to get that, we're going to have to reverse. And then if we do, then we put in a divergent high, and we could have a nice pullback in yields and make a case to go long treasuries. And then that falling yields, it could be supportive of new highs in the stock market, unless it's a flight to safety bid. So again, I may engage treasuries. My next trade on treasuries will probably be to the long side. I don't have a position right now. Told you when I got back from vacation, that was it. Close that out and kind of wait and see. But we'll see. So this is setting up, but what happens, because we've broken out of a primary trend line and we've taken out this previous high, we could just keep going up here. And this would be, as I've stated, we will enter my red zone if we continue to see yields drop. Yields rise, and then that will most likely trigger a very strong drop in the stock market. Okay, so I just laid out what I do every day, things to watch, developments that may or may not happen, but more importantly, the levels to watch, and then how to position, or at least factor that into your trading, if so. And some of you may not want to have anything to do with treasury bonds. You might not want to trade them. I can just tell you it will enhance both your swing trading as well as your longer term investing if you can incorporate what treasury bonds are doing, or even more importantly, what they're likely to do. That's why we read the tea leaves. We look for turns in the market. Like we got these two turns. We were long. This is the yield, so it's backwards. We were short treasuries here as yields are rising, long treasuries there, and then covered and got out of the way there. And you can see now that we're coming up on this previous high right there, these previous two highs in TNX. If this continues to go, we're going to have real problems. The stock market will. I mean, we'll be making money shorting it, but it'll just reinforce the fact the Fed has utterly and absolutely lost control of the long end of the curve. Like I said, Powell tried to just downplay and dismissed, and I think the reporters were way too easy on him yesterday, not asking the tough questions about that. So there it is, guys. Everything to watch. Finally, other things I watch besides treasuries, I look at muni bonds. I watch California. Here's California muni bonds just plummeting right now. That that raises the cost of capital. California is a very spend everybody's money state. No offense to Californians. I know that if you're listening to my voice, you trade stocks, you probably have money to pay their state income tax, and what is it, the numbers of people that pay tax in the state versus those that don't, it's crazy. It's even more so than I think overall in the U.S. economy and nationwide. But anyway, I watch that. I watch high yield bonds, which are falling pretty good today. So that means credit spreads will probably continue to tick up. I do watch credit spreads. I've been watching them rise recently. MUB is a general national municipal bond ETF. So what happens here is this matters. These are, you see muni bonds now approaching this previous low. That means yields are shooting up. That means the cost to borrow money. All municipalities, they issue money. You know, they have income streams from taxes, just like the federal government, but they also are very large issuers of bonds to finance things such as schools, roads, bridges, police, fire, you know, pensions for teachers, and city and municipal workers, et cetera, et cetera. And so, you know, if we continue this down, that's going to be very, very bad overall for the economy and the stock market. JNK, junk bonds coming up on support right now. That's one junk bond ETF. I also watch HYG. It's another junk bond ETF. You can see it recently broke support, testing the 200 days. They keep buying the 200 days. They bought it here. They bought it here. If it breaks the 200s, then you're going to be in a downtrend. When you're in a downtrend, like you were back here, let me turn off all the lines, just like the stock market. Once you break the 200s like you did there, you're in a bear market, and the MO is the short rallies back to the 200s. And once the 200s are clearly regained right there, you're in a bull trend. And so this was a trend of falling interest rates, and you just buy pullbacks there, and we're there again. And you know, if the stock market's going to new highs, junk bonds will go to new highs most likely. Junk bonds trade more like stocks than they do bonds. They're more dependent on economic conditions than interest rates, unlike other bonds. But again, so watch this. If we start breaking down below the 200 days, it triggers signals that the trend has changed. And based on the technicals, that seems to be the most likely case. This was a divergent high right here. You just broke this trend line, and that's that. So there it is, guys. There's everything to watch. Nat gas, not much more to say about it. I still want to see it. It should scream and hit my $5 target if and when this level goes about 365, call it 370, somewhere in there. Again, that's my 2-hour candle chart. On the 60-minute chart recently, I highlighted this most recent divergent low. We keep walking up. We're in the makings of a near-term uptrend. We just need to pop those recent highs, and that will become apparent to most, and that will be a bullish technical development. But so far, we're making lower lows here, and each one being a divergent low, including this one I highlighted the other day. And that's it. Natural gas is up about 15% since then, but we still got to pop that 366-ish level to open the door to that run up to about $5. Okay, long enough video. I'll watch the first part of the video, see if I left anything out important when I had that pause snafu. But I'll get this out to you, and we'll see how we close today and how we close, especially how we close the week tomorrow. That'll be the big thing. This has been Randy Finney with Right Side of the Chart. Have a great day.